Good morning, everyone. Welcome to the Supreme Cannabis Company Inc. fourth quarter and year-end fiscal 2020 results conference call. Listeners are reminded that certain matters discussed in today's conference call or answers that may be given to questions asked could constitute forward-looking statements that are subject to risks and uncertainties relating to Supreme Cannabis's future financial or business performance. Actual results could differ materially from those anticipated in these forward-looking statements. The risk factors that may affect results are detailed in Supreme Cannabis Annual Information Form and other periodic filings and registration statements. You can access these documents at SEDAR's database found at sedar.com. I'd like to remind everyone that this conference call is being recorded today, Friday, September 25th, 2020. I would now like to introduce Ms. Beena Goldenberg, President and Chief Executive Officer of the Supreme Cannabis Company Inc. Please go ahead, Ms. Goldenberg.
Thank you, operator. Good morning, everyone, and thank you for joining us for today's call. On the call with me is Nikhil Handa, our Chief Financial Officer. We released our fiscal 2020 fourth quarter and full year results after markets closed yesterday. You can access our news release, as well as our complete financial statements and management discussion and analysis on our website at www.supreme.ca. Our news release, financial statements, MD&A, and annual information form have also been filed on SEDAR. On today's call, we'll discuss the financial results for the 3 and 12-month periods ending June 30th, 2020, and I will provide a general business update. We will then open the call for questions from analysts. So to start, I'd like to say how pleased I am to be part of the Supreme Cannabis team and to host this call with investors. I joined Supreme this past April because I was drawn to the company's focus on quality, not just in our products, practices, and facilities, but in the emphasis our people place on continuous improvement across the organization. I believe the roadmap to success in the Canadian cannabis industry lies in companies that operate as true consumer product companies in terms of understanding consumer usage and attitudes, developing product and marketing strategies, and supporting with efficient operations. Supreme Cannabis is capable of becoming one of those premier cannabis CPG companies, and to date, we have made significant progress. So let's talk about that. In our progress to become a premier cannabis CPG company, we focused on building a differentiated marketing presence and a product offering that serves the broad range of cannabis consumers, from the novice user to the enthusiast to the discerning cannabis connoisseur. It's often said today that the Canadian market is a value market, where consumers are only looking for low-priced products. While this is a growing segment, at Supreme Cannabis, we see opportunity and have had success at serving the knowledgeable cannabis consumer that is seeking a more informed experience. For example, we are creating excitement with our 7 Acres Craft Collective strain. We have introduced unique craft-grown strains such as Pink Kush and Wild Berry OG in limited drops in Ontario and BC, and have expanded Pink Kush to the remaining western provinces and Quebec post-quarter, along with introducing a new strain, Ice Cream Cake. The strains sell quickly and achieve high visibility on social media with strong online reviews. This further reinforces the premium brand positioning of 7 Acres. We now meet consumers at several price points of value and preference, with 36 active SKUs operating under a portfolio of brands that includes 7 Acres, Sugarleaf, Blisco, and Highway. With Highway, we are planning to serve the value-conscious consumer and expect to introduce large-format full flower offerings in fiscal 2021. We also continue to expand our Cannabis 2.0 offering. In August, our 7 Acres concentrate launch in Alberta was very successful. We saw a 5.8% market share for this brand within this category, while our 7 Acres pack pods also reached almost 2% market share in Alberta. Our brands are performing well, and we continue to grow our market share overall. According to Headset, 7 Acres gained 3% of the total flower, concentrate, pre-roll, and vape value share market in July in Ontario, Alberta, and BC. This pushed 7 Acres brand ranking up from number 11 in January 2020 to number 8 in July 2020. We also significantly increased brand awareness for 7 Acres. According to Brightfield Group's quarterly consumer tracking study, which is a quarterly survey with 3,000 legal age cannabis users throughout the nation, 7ACRES awareness reached 13.5% in Q2 2020, compared to 9% in Q1, making 7ACRES the 10th most known brand in the country. To accelerate our retail presence in Canada, last year we established a sales agency agreement with Humble & Fume. They are the leading distributor of cannabis accessories in Canada, and their established relationships with both government and private retailers has led to 1,290 new listings, and our company being listed in as many as 296 new stores in a matter of 3 months. COVID-19 restrictions limited Humble & Fume's sales efforts to virtual and telecommunications for most of April and May. Towards the end of the quarter and after quarter end, many retail stores opened, and reps are now engaging directly with operators. This allows for further opportunities for promotions, new product introductions, and adding new retail outlets. As we focus on our Canadian business and achieving near-term profitability, we continue to pursue capital-light international opportunities. Within 3 months, we have already executed on our strategy by completing 3 medical cannabis shipments to Israel under our contract with Breath of Life Pharma. This contract builds Truvera's global medical brand and creates opportunities for future international medical sales to Israel and other international cannabis markets. In fiscal 2020, particularly in the second half of the year, as we prioritize revenue growth in the Canadian market, we focused on optimizing our facilities in Kincardine, Ontario, and Langley, BC. Our facility in Kincardine made significant advances last year, with construction and licensing being fully complete in the third quarter. Kincardine is now licensed for 280,000 square feet of flowering, vegetation, and propagation space. This facility also has 2 automated bottling lines. In the fourth quarter, we continued to optimize Kincardine to improve cultivation yields, energy usage, and processing throughput. With the growing interest in higher value Cannabis 2.0 products, we built a capability around concentrates production. 7ACRES branded rosin produced at the facility reached the market this past June. Also, Highway Hash, a new product under the company's value brand, was introduced in August. We also completed the facility's conversion from propane to natural gas, which results in significantly improved efficiency and consistency. We expect this improvement to save us $1.5 million annually. Now, with concentrate and pre-roll production and plans for our Kincardine laboratory, we have an efficient, self-contained facility from genetics to growing to conversion and packaging. With this consolidation of operations at Kincardine, in the fourth quarter, we made the strategic decision to close our Kitchener facility. Moving to the west, we completed the construction of our extraction facility in Langley, BC in Q2, and it was approved by Health Canada at the end of Q3. This facility can produce over 7,000 tincture bottles annually and is filling 7ACRES Pax Pods, Sugarleaf 510s, as well as the Blisco line of full-spectrum oil. I'm pleased to say that we now have the facilities right-sized and optimized to execute our business plan. With these facilities complete, investments in capital expenditures were $1.1 million in Q4 compared to $2.3 million in the previous quarter. We expect minimal capital expenditures in fiscal 2021. Now, Nikhil will discuss the financial results for the quarter, and then I will return to discuss outlook and take questions. Nikhil?
Thank you, Beena, and good morning, everyone. As Beena mentioned, our Q4 captures April, May, and June, which you will recall was the beginning of various pandemic measures put in place by the government. This led to a great amount of uncertainty in the marketplace, and as a result, Supreme Cannabis continued to focus on the things that it could control, the offering to our customers and our costs. For our customers, Beena had previously outlined our compelling product offering. For our costs, we continued to optimize our operations to ensure we were focused, which had the benefit of reducing our operating costs even further. Q4 saw net revenue decrease slightly by 2% to $9.5 million from Q3, primarily driven by the company's continued shift from the wholesale channel to focus on the recreational channel. While recreational sales were driven by both increases in volume and ASPs, wholesale sales declined due to lower ASPs and product mix. Recreational net revenue climbed to $7.3 million in Q4 2020, up 28% compared to Q3. Rec sales volumes were 1,449 kilograms, up 10% over last quarter, while the average selling price per gram for the rec channel was $5 in Q4, up 16% compared to Q3. This quarter-over-quarter increase in rec average selling price was driven by lower discounts and returns provisions in the fourth quarter compared to the third quarter, along with an improvement of mix due to the inclusion of new products. The recreational sales channel accounted for 76% of net sales in Q4. As we continue to shift away from wholesale, we saw wholesale net revenue decline 43% from last quarter to $2.3 million in Q4. Wholesale sales volumes were 1,330 kilograms, up 4% compared to Q3, while the average selling price was $2.74, down 18% from Q3. We will continue to execute on our strategy to become a premium CPG cannabis company with a corresponding increase in our recreational channel sales in coming quarters. Now, for the period, there were two impairments totaling $15.5 million. A non-cash impairment on PP&E and other prepaid assets of $3.4 million, and a $12.1 million impairment of inventory, which was included in our production costs. If you exclude the $12.1 million impairment charge reflected in the company's production costs, the normalized gross margin for Q4 was 41%. Now, if you exclude the amortization expense of $2.2 million included in the company's production costs, the company's cash gross margin was 64% for Q4. Moving on to our operating expenses. In Q4 2020, the company's operating expenses decreased 9% to $15.9 million from $17.5 million in Q3 as a result of further right-sizing operations. Q4 operating expenses were down by 20% since Q2 when these right-sizing initiatives began under new leadership. Cost efficiencies were driven by a quarter-over-quarter decrease in wages and benefits of 24%, a decrease in facility costs of 57%, and a decrease in sales, marketing, and business development expense of 31%. These reductions, though, were offset in part by a 93% increase in G&A expenses, driven by a non-recurring $2.2 million write-off related to an accounts receivable balance that the company deemed as uncollectible during the period. Now, this was related to a legacy B2B customer for a transaction that occurred over a year ago. The cost reduction to Supreme's operating expenditures are results of the steps the company took in Q3 and Q4 2020 to realign and right-size our operating model. Supreme moved closer to profitability this quarter. Adjusted EBITDA improved from a loss of $5 million in Q3 to a loss of $4.2 million in Q4 due to improved cost control measures taken to streamline the company's business and right-size its operations. It is worth noting, though, that this $4.2 million EBITDA loss includes that one-time accounts receivable write-off of $2.2 million. So if you were to adjust for this one-time write-off, our adjusted EBITDA would have been a loss of $2 million. The company remains focused on accelerating near-term revenue growth while realizing cost savings and driving efficiencies. Turning to the balance sheet, the company's balance sheet continues to be strengthened with purposeful actions taken by the management team, and subsequent to quarter end, we took major steps towards bolstering the balance sheet, which I'll get to in a moment. As at June 30th, 2020, the company had $28.4 million of unrestricted cash with $19.9 million in current liabilities. Supreme's cash and liquidity position means the company has the current resources available to settle its current liabilities, and we're fully funded to execute on all our planned initiatives for fiscal 21. In Q4 2020, the company also established an at-the-market equity program that allows for the issuance of up to $9.75 million of common shares at the company's discretion. Now, this program is designed to provide additional financial flexibility and raise equity in a responsible manner if required. In the quarter, the company issued about 5.3 million shares for proceeds of approximately $1.8 million. Subsequent to quarter end, we increased the company's financial flexibility by refinancing its convertible debentures and amending its credit facility. In September, Supreme completed the refinancing of its convertible debentures, which helped optimize our balance sheet by reducing debt. As part of this refinancing, $63.5 million of the $100 million principal amount of the debentures were converted to equity by issuing 117 million common shares to debenture holders, a conversion that reflects a significant premium to the current share price. Amending the debentures was an efficient use of the company's share capital and gave the company a tremendous amount of financial flexibility. Not only did it reduce the company's debt load by $63.5 million, but it also lowered our interest payments by over 50%, freeing up cash to invest in strengthening the business and capturing value-generative opportunities. We also pushed back the maturity on the remaining $36.5 million of principal from October 2021 to September 1st, 2025. So instead of having $100 million coming due in October of next year, we have the lower refinanced amount maturing in 5 years. This refinancing was a crucial step in strengthening the balance sheet of Supreme. Also subsequent to quarter end, the company amended its senior secured credit facility. The amendments provide Supreme with a longer runway to execute on its business plan before the credit facility converts to cash flow covenants, such as leverage metrics. Specifically, the debt to EBITDA and fixed charge coverage ratios were extended by 1 year to beginning calendar year 2022. In turn, the credit facility sizing was optimized and the interest rate was increased by 75 basis points to reflect current industry dynamics. With the refinancing of our convertible debenture and the amendment of our credit facility, Supreme has reduced its overall leverage, reduced its cash interest expense, and has no maturity for the next 2 years. Thus, we have ample runway to execute on our business plan. These changes reflect a supportive relationship with Supreme Cannabis' debt holders and their confidence in our business plan. Supreme is focused on maximizing shareholder value, and it believes it continues to take the appropriate steps to accelerate revenue, contain expenses, drive to profitability, and strengthen the balance sheet, all in order to support value creation in the long term. And now I'd like to turn the call back to Beena.
Thanks, Nikhil. To close, I am encouraged by the speed at which Supreme Cannabis' transformation is unfolding. We are on solid financial footing, fully funded to execute on all our planned initiatives. In fiscal 2021, I am committed to leveraging these advantages to capitalize on value creation opportunities. While I acknowledge the frustration and disappointment some shareholders are feeling, the progress we continue to make, though not yet reflected in our share price, is genuine. I am confident that Supreme is built to last, and the positive changes we made will manifest themselves in robust results and shareholder value. I want to express my gratitude to our board for their valued support and guidance, as well as our employees for their dedication, resilience, and ingenuity. You have been instrumental in transforming and positioning Supreme Cannabis for sustainable profitability, revenue growth, and value creation. I also want to thank our shareholders for their ongoing patience and confidence in the company. I can see a clear path ahead for Supreme, one that will benefit our investors, consumers, and employees, and I look forward to updating you throughout the year on our progress. This concludes the formal presentation. So thank you. I'd now like to open the line for analyst questions.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Should you have a question, please press the star followed by the 1 on your touch-tone phone. You will hear a 3-tone prompt acknowledging your request. If you are using a speakerphone, please lift the handset before pressing any keys. One moment, please, for your first question. Your first question comes from Tamy Chen from BMO Capital Markets. Please go ahead.
Hi, good morning. Thanks for the question. First, I just wanted to clarify what I heard. Beena, did you say that in July, your retail market share overall in Ontario, Alberta, and BC was 3%?
Was 3%, yes.
Okay, thanks for that. And next, I wanted to understand a bit better. Could you help us just detail through, I believe as part of the credit facility amendment, there are, I guess, covenant requirements to achieve positive EBITDA, I believe positive $2 million in fiscal Q2 21, and then by fiscal Q4 21, positive $4 million. Can you just help us detail through, your plan to achieve that?
Certainly. Thank you for the question, Tammy. So first of all, we recognize that getting our business to sustainable profitability is top priority. It's not just about reaching the profitability, but it's to become sustainably profitable. And so you've heard we've focused on cost reductions that you've seen over the past 2 quarters. We've streamlined our operating structure. We continue to focus on growing our rec channel, which was our strategy, and we've made a lot of progress there. And as a result of those, we believe we are on the path for near-term profitability. Nikhil, I'll leave you to continue that response.
Thank you, Beena. So, Tammy, we don't foresee any issues in achieving any of the covenants in our amended debt facility. We obviously maintain good relationships with our lenders, and the fact that we're able to amend our credit facility and our convertible debentures in a challenging environment, we believe is a testament to both the convertible debenture holders and the lenders' confidence in Supreme's business plan. So while Beena had outlined some of the factors that are occurring internally that we see help to accelerate growth, continue to contain costs, and drive us to sustainable profitability, we do have to be mindful of various factors that are outside of our control, such as changes in the marketplace due to COVID-19 restrictions or regulatory or government impacts on the cannabis industry. So with all that as context, assuming no significant external impacts to the marketplace, and if we continue on the current trajectory, we expect to hit all those EBITDA milestones.
Okay, got it. And my follow-up question is, Beena, you've been here for a number of months now. Could you kind of walk us through overall, particularly in trying to continue the rec momentum? I mean, what is the strategy here, given everything that's going on in the market, what your competitors are doing, what your top priorities are for the company? And also, as you've had the time now, where do you see Supreme's strengths are and maybe the areas for improvements would be? Thank you.
Great. Thank you for the question. So first of all, you're right. I've been here now just under 6 months, and I've had a great chance to understand what the strengths are we have in our go-to-market strategy. We have a portfolio of brands between our 7 Acres that meets the premium market, our 7 Acres Craft Collective that really targets the connoisseur. But we also have our Sugar Leaf that is directed towards novice users of cannabis with more convenient formats, Blisco products that really target the wellness consumer, and as we launch our Highway brand to really target the value-conscious consumer. So we've done a great job in expanding our portfolio to meet all the different consumer segments and with products at various price points throughout. This gives us the opportunity to continue to reach and build our portfolio, be out there in the retail stores, and drive that strength. You asked where I see the biggest opportunity for Supreme. It certainly fits with our 7 Acres brand. We've got great brand awareness, great premium positioning. Like I said in the speech, really, certainly the value segment is growing, and we will play in the value segment with our Highway brand. But we are differentiated with our 7 Acres brand. It is something known out in the marketplace for quality, not just potency level, but also our terpene levels, for aroma and taste. And we have market research that shows we're known for that. And so that's the play, to really focus on differentiating on our quality positioning out in the marketplace and building our number 1 brand in a bigger way. You asked about what I think as, some of the next steps. Really, it's about building our distribution. We spent time with Humble and Fume over the quarter. It was a little bit more challenging when we had COVID and they weren't able to get into the stores. We focused their time and effort on building out our core items in new stores. They obviously have relationships with new store owners as they want to outfit their stores with accessories, and we built out our portfolio of core products in those stores. But then we switched our focus really on new products. As you saw, we launched a lot of new products over the course of both fourth quarter and really the start of this quarter, and to expand our portfolio. Your final question, I think, was what do I see as our weakness? Well, I think really the challenge with marketing in the cannabis space is you could reach consumers really only in two areas, both online and in store. And I think we have a great online presence with our 7 Acres in particular brand and in store with Humble and Fume. But I would say that packaging is a challenge in store with the regulations from Health Canada. The packaging is difficult to differentiate, and we have some work to do to find a way to break through with our packaging in store. I hope that answers most of your questions.
It does. Thank you.
Thank you. The next question comes from Graham Kreindler from 8 Capital. Please go ahead.
Yeah, hi, good morning, and thank you for taking my questions here. I just wanted to follow up on some of the remarks regarding, I guess, the overall traction of the company's products as well as the demand picture, particularly on the sell-in side. I appreciate the commentary into the month of July. I was wondering if you could give us a bit of an idea on how things are looking into August and September, whether that's from just the overall market share or velocity side of the brands, or if you could comment with respect to the sell-in in the provinces and the order patterns, whether that's remained steady or there's still a lot of volatility on that end. Thank you.
Great. Thank you for the question. What we're seeing is with the stores opening at the end of June and into July, we're certainly seeing more traction. Being able to get into stores and running promotions in stores has helped us create that demand. I'll give you an example. We ran a great bundle promotion with our PAX pods and the vaporizer in Manitoba with Delta 9. And we saw great promotional lift from that activity, but also repeat purchase post-activity, which is something we like to see. So those are the kind of things as we build promotions with our retailers, and we've continued to take that promotion, a bundle promotion across the country. It's driving traction on demand. And that's really important because what's changed in the industry over the last 6 months is that the provinces and the retailers are replenishing based on demand. They're just not taking any inventory. They want to make sure the product is moving through to the consumer. And as we've seen that change, we've modified our plan. We're working on driving demand so we get those replenishment orders. And that's really how that typical CPG company would work. So we're leveraging that experience and driving our traction that way. You asked about Q1. We have seen continued momentum. I talked a little bit about July results in our market share. We continue to have opportunities of added distribution with our Humble and Fume team out in the street. We've built out the team. We actually arranged the partnership back in February and got a little bit sidetracked during the COVID, didn't fully expand our foot coverage across the country, and we're able to get back to filling out the roles in late June, early July, so we have more feet on the street to drive more of promotions across the country. So I'm feeling really good about the quarter, about how we've done. I'm pretty comfortable saying that we'll see sequential quarter-over-quarter growth on our rec sales.
Okay, great. Thank you. I appreciate the color there. Then just a question about the inventory position at the end of the quarter, which was, I believe it was $30 million, and the majority of that being in finished goods. Now, I know there was some right sizing of the inventory that occurred in the quarter. I'm wondering, with respect to the product that's sitting there in inventory today, and the company continuing to diversify its product and brand offering, I guess how nimble, how flexible is that inventory sitting in finished goods with the ability to be deployed across the various product and brand spectrums? Thanks.
That's a great question. Nikhil, why don't I pass that one over to you?
Thanks, Beena. Thanks, Graham, for the question. So I guess maybe at the outset, we'll just say don't anticipate significant increases in the inventory. What we're really focused on right now, whether it's finished goods, WIP, or otherwise, is matching our current production to the demand plan, basically to ensure that we have the right fulfillment rates needed by our retail partners and the provincial wholesalers, as Beena had mentioned, who are moving much more to demand-driven. So when you look in the breakdown or a finished goods line, you may see some increases in certain brands as we work towards having greater levels of safety stock. As a whole, though, not significant increases. So as you think about the provinces moving towards more demand-driven replenishment, we're matching our inventory to that demand as much as we can, and thus we need to keep on building up more safety stock and finished goods to ensure we can promptly fulfill orders to be a good partner.
Okay, thank you very much. And then my last question here, in the past, getting the proper packaging or getting the proper throughput on that packaging had been a bottleneck for the company. I was just wondering if you could provide a bit more of an update on how the downstream processing is working now, and I guess also in light of having more products and more brands, which likely means different types of packaging, how that capacity is working now, and if there's any other improvements that are required. Thank you very much.
Sure. Thank you for the question. We've continued to optimize our operations. As I mentioned, in Kincardine, we've got our automated bottling lines working. We brought our pre-rolls in-house over the last quarter and continue to build our capability there. We launched into more of the 2.0 products and have our vapes being processed at our Langley facility. And so, like anything, new products are hard to forecast, and we continue to build our safety stock and try to understand the demand signal as we roll out these new products. And it's not perfect, but we get better every day and continue to try to drive the distribution of these new products and fulfillment. So what I like about it is we've got the capability in the house. I like the fact that the team in our operations understand that we have to fill our orders and are out there putting in the hours required to respond to demand, and that is the goal, to continue to deliver what's required in the format that we've expanded our lineup to include.
All right, thank you very much. Appreciate it.
Thank you.
Thank you. Your next question comes from Andrew Partheniou from Stifel. Please go ahead.
Hi, and thanks for taking my questions. Maybe we can start with the Humble and Fume relationship. Just curious, in your press release, you mentioned the number of new stores penetrated in July and August versus Q4. It seems that it has decelerated somewhat, which is a little bit counterintuitive given the challenges in penetrating new stores during the COVID lockdowns. If you could give a little bit more color to understand the dynamic there.
Sure, Andrew, thank you for that question. So I'd like to make some things clearer. So first of all, during the store shutdowns in the quarter under COVID, our Humble and Fume team spent a lot of time managing their relationships with new store owners, helping them outfit their stores, and obviously taken some of our core products into those stores. So building out new store distribution was the focus in the fourth quarter. As stores started to open at the end of the fourth quarter and into July and August, we shifted their focus from the building out new store distribution to driving promotions to drive demand. So as stores opened, we could get back in there and drive some of that promotion. But also you saw how many new products we launched, and the focus was shifted to expanding the distribution breadth of our portfolio in existing stores. So both are important, obviously getting distribution in new stores, but expanding our portfolio in already existing stores. So I think the key measure really is talking about the number of new distribution points, so the 1,290 new distribution points, because that combines either both new stores and breadth of portfolio in existing stores.
Okay, that's a very helpful color. Just to follow up on that, could you give some kind of a cadence in that 1290? Perhaps what was done in Q4 and what has been done in Q1 to date?
Well, you know what? We have to get to some better stats to record distribution gains, but what I can tell you is at the end of Q3, our distribution in Ontario, in the Ontario market, was at 74%, and at the end of Q4, we got to 87%. So we certainly saw the general distribution growth. Again, we have to do a better job of what is distribution runway, whether it is new products or new stores and distribution points. So that will be a follow-up. We'll get to a stat that helps you understand quarter-over-quarter growth over time. By market, the numbers right now, what we get out of Ontario and Alberta are slightly different. So we will get back to you with that as we get cleaner scores on our distribution growth.
Thanks for that helpful color. And maybe if we can change gears and look towards your new craft line, if you could talk a little bit more about that, how is it doing? Perhaps if you could give a little bit of detail in terms of what percent of sales it was in the quarter, or what kind of margin profile, if you could remind us what it is on these types of products, it could be helpful. Thanks.
No problem. So we're very excited about how our craft collective is doing in the marketplace. It's a small percentage of our sales because we've just been doing limited drops of these strains, and they've been unique to provinces. So, just to BC or we just recently expanded the Pink Kush to several of the provinces across the country. We're doing that. So it's really about driving excitement against the overall 7ACRES brand, right? We get great buzz, online buzz, consumers feedback, and they go in to look at them, sort of a treasure hunt. Will they be there? What is the new strain available? So we're very excited that it provides more of a marketing positioning for 7ACRES in terms of a premium quality. In terms of absolute margin, it's going to have lower margin than our core 7ACRES at this point, because currently, while the average selling price will be higher given its unique strains and limited drops, we are currently buying in the product as opposed to self-manufacturing to get these unique strains. What's important to think about, though, is we are working very hard behind the scenes on our genetic program at our Kincardine facility. Look forward to introducing some craft strains out of our own facility in the back half of this year, and that will drive the margin on our craft collective up significantly. So that is, right now we're excited about how it's performing and really see margin expansion in the back half of the year.
Thanks for that additional color. And just one more for me. Just with your marketing expenses and the relationship again with Humble and Fume, very impressive that you guys have saved so much on SG&A overall, but also noticing that you guys have saved on the marketing line as well, despite that ramp up in the Humble and Fume relationship. Trying to understand that a little bit more on going forward. How could that line trend? Would you say that the relationship would allow for lower than normal marketing expenses, or as the relationship with Humble and Fume continues to develop, we should expect that line item to go up accordingly?
So it's a good question. We will see some more sales and marketing expenses as we have built out our number of street representatives across the country, and they go in store and more of the materials in store. So we will see increased sales and marketing costs going into first quarter and probably into second quarter until it levels off at what we expected to spend. We certainly underspent against our brands in fourth quarter because stores were closed and we weren't able to get in there and leverage our materials. That being said, we had our cost reductions in Q4 that occurred during the quarter, and we expect to see some of those being fully realized as we move into Q1. So while some of the sales and marketing expenses will go up, we have offsetting cost reductions that will also occur throughout the quarter. So it's important that we support our brands. We will continue to support them online and in store. We know that we have better gross margins if we sell more product, and we could support the increased marketing spend from that point.
Thanks very much. And congrats on your first earnings call.
Thank you.
Thank you. There are no further questions at this time. I will now turn the call back over to Beena Goldenberg for closing remarks.
Well, thank you, everybody, for participating today. As Andrew just mentioned, this was our first earnings call, and we appreciate you taking the time to join us. We look forward to discussing our fiscal Q1 results in November, and to continue to update you on our progress. So with that, have a great day. Thank you again.
Ladies and gentlemen, this concludes your conference call for today. We thank you for participating, and we ask that you please disconnect your lines. Enjoy the rest of your day.